CoreWeave just announced a $6.3 billion deal with Nvidia, and that sent their stock up 8%. And everyone is calling it a massive win. But I'm here to tell you why this deal has got a whole lot of red flags and why it reminds me of another success story that completely imploded, Ginkgo Bioworks. Curious? Stay with me because what I'm about to show you could save you from a very expensive mistake. What's up everyone? Welcome back to Share Trend. I'm your host, Raj. And today I'm breaking down the investment stories that Wall Street doesn't want you to understand. Today we are diving deep into CoreWeave, ticker CRWV, and why that headline-grabbing Nvidia deal might be the biggest red flag in AI investing right now. And before we get started, if you find this analysis valuable, smash that like button and subscribe because we're going to be covering a lot more of this hidden risk in the AI space. So let's start with what actually happened. CoreWeave announced that Nvidia will guarantee to purchase any unused cloud computing capacity through April 2032. That's not just until next year. We are talking about a 7-year commitment worth $6.3 billion. Now, on the surface, this sounds incredible, right? Guaranteed revenue, locked-in customer. What could go wrong? Well, here's where it gets interesting. And by interesting, I mean concerning. Nvidia isn't just CoreWeave's customer. They are also an investor. Nvidia holds 24.3 million shares of CoreWeave worth around $4 billion. So we have a situation where Nvidia is simultaneously the supplier of GPUs, an investor in the company, and now a guaranteed customer for their services. This isn't an arm's length transaction between two independent companies. This is what I call a circular relationship, and history shows us these arrangements rarely end well for outside investors like us. That brings me to Ginkgo Bioworks and why I think every CoreWeave investor needs to understand what happened there. Ginkgo was once the darling of synthetic biology, trading at astronomical valuations, but their business model had a fatal flaw. They were essentially booking revenue from subsidiaries and affiliated entities. They created artificial demand by selling services to companies they had financial relationship with. And that's what was being mentioned at that time by the short sellers as well as the media. Sounds familiar? The regulatory risk came fast and hard. Short sellers exposed how Ginkgo's revenue couldn't be traced to genuine third-party customers. When that artificial demand dried up, the stock collapsed from highs of over $15 to under $1. Now, I am not saying that CoreWeave is behaving exactly like Ginkgo did, but the structural risks are somewhat similar. When your biggest customer is also your investor and supplier, how do you separate genuine market demand from financial convenience? Let's talk about CoreWeave's underlying business model because this is where things get really concerning. Kerrisdale Capital, yes, the same short seller that called out many previous bubbles, has a $10 price target on CoreWeave. They're calling it a debt-fueled GPU rental business with no moat. Think about that for a second. CoreWeave borrows money to buy GPUs from Nvidia, then rents those GPUs as cloud computing services. Their collateral, the same GPUs they are renting out. It's like taking out a loan to buy rental properties, but your rental properties are the collateral for the loan. This works great when the demand is high and GPU prices are rising. But what happens when the AI bubble cools down? What happens when companies realize they're overpaying for cloud computing? What happens when newer, more efficient chips make CoreWeave's current inventory obsolete? The entire business model depends on continuously high demand and rising prices, the exact conditions that define a speculative bubble. Here's another angle that investors aren't talking about enough. Regulatory risk. Nvidia already controls 80% of the AI chip market. Now they are essentially backstopping one of the major cloud providers that uses their chips. This creates potential antitrust concerns because Nvidia is simultaneously controlling supply, influencing pricing, and guaranteeing demand. Think about it. If Nvidia can guarantee that CoreWeave will always have a buyer for their services, they can justify keeping GPU prices artificially high. Higher GPU prices benefit Nvidia's margins, and the guarantee ensures CoreWeave can afford to keep buying more GPUs. It's a closed-loop system that benefits both companies at the expense of genuine market competition and price discovery. So, what does this all mean if you're thinking about investing in CoreWeave? In my personal opinion, again, everything I'm saying is my personal opinion, not financial advice, so please do your own due diligence. I would say that first we have to understand that we are not just betting on the company's ability to execute. We are betting on the sustainability of artificial demand created by third-party transactions. Second, we have to recognize that the concentration risk is there. CoreWeave's success is entirely dependent on their relationship with Nvidia. If that relationship sours or is prohibited, if Nvidia's business priorities change, or if regulators step in, CoreWeave could be left holding billions in depreciating assets with no guaranteed buyer. Third, consider the leverage. This is a debt-heavy business model in a cyclical industry. When the cycle turns, and as it always does, highly leveraged companies are usually the first casualties. This isn't just about CoreWeave, this is about understanding how artificial demand can distort entire markets. When major players create those circular relationships, they can make their sectors look much healthier and more sustainable than they actually are. Other investors see the headline numbers and pile in, creating momentum that's based on financial engineering rather than genuine economic value. We have seen this movie before in .com, in housing, in crypto. The players change, but the script remains the same. Look, I'm not saying CoreWeave is definitely going to collapse like Ginkgo did, but I'm saying that the structural risks are real and they're not being priced into the current valuation. And again, this is my personal opinion, not financial advice. I could be wrong. I would like to hear from you guys what you think. Put it in the comment section. I like healthy criticism and I get to learn from our community as well. The $6.3 billion Nvidia deal might look like a massive win, but scratch beneath the surface and you'll find the same red flags that have destroyed shareholder value time and time again. As always, do your own research, understand the risks, and never invest more than you can afford to lose. Friends, if you found this analysis helpful, hit the like button and subscribe for more deep dives into stories like this. And every time you press a like button, YouTube algorithm understands that it can send this video to more people like you who would actually appreciate this video. And also, please let me know in the comments, are you buying the CoreWeave hype or do you see the same red flags I do? Thanks for watching, and I'll see you in the next one. Bye for now.